Okay, good afternoon, everyone. Thank you for having us up here today. I've been kindly asked by Christina to skip introductions, so we'll get right into the conversation here. I thought a good backdrop, so Omni's an analytics and infrastructure platform for venture capital, so we study venture data and deals. It's sort of what we do all day long. And I thought a great framing for the discussion today would be to really dig into the state of the market. And so I've pulled some year-to-date 2022 data, looking at hundreds of deals that have already occurred this year, comparing that to the last year and even the prior 5-year period before that. And what we have all probably heard is that the growth equity sector of the market is slowing down and cooling off quite a bit, almost coming to a halt. But what I had been hearing just from investors very frequently is that the earliest stages is really still on fire and there's lots of velocity and volume. But it turns out when you pour into the data, I actually find that to be not entirely true. And so we are seeing at the earliest stages a lot of slowing down as compared to 2021. Now, granted, compared to historical, we're still in a pretty big uptick, but at the earliest stages, definitively in the data, we are seeing deals slowing down, amount of capital being raised, the pace at which companies are raising. So thought I would start there, and joined by my lovely guests here, George from Woven Capital, Lucas from Be Tomorrow Ventures, and Jeff from DLA. And so I thought we'd start with Lucas. And with that backdrop, we were just chatting before the session. What is the posture and behavior that you're seeing in the corporate venture community, maybe broadly, but even specifically at the earliest stages? Because I think my insight caught you off guard a little bit.
Sure. So interesting question. Thank you. I think in one of the previous sessions, Dina from Stanley Ventures mentioned that in the difficult times, corporates do not have luxury to change the strategy. And that's definitely what we see. We see corporates remaining bullish. I think that some of the practical observations that I can share with you is that in the markets of Asia, but also Europe, despite the political turmoil, we see that for the best startups, corporates are competing quite fiercely. So that's one observation. The other one, what we noticed is that CVCs seem to have learned from the past mistakes, and they are communicating quite clearly with the market that they are there to stay, which is great, very transparent market communication. And I think that the last point that we are seeing is that corporates try to remain supportive to their portfolio companies. So they reassure them, and they still have capital to deploy to the follow-on investments. So I think that the posturing overall is quite positive. Like, to me, it sounds something along the lines, we are here to stay, we will be supportive, and we will keep on investing.
Yeah, and I think maybe for you and George even, I know your scope is global, and do you see any, either between the two of you, any differences just in some of the geographies in terms of responding to the market conditions?
Well, maybe it'd be good to have Lukasz speak of Europe, because he was telling us before when we were outside kind of what he's seeing in Europe.
Yeah, so I think that in Europe you would expect that things are going to be tough, and we are seeing fierce competition for the deals. Like, in fact, just this week, I think that we are fighting to survive and maintain our investments into the project. So you see early stage, this is early stage, pre-Series A, but it seems like that the market impact has not really reached, at least significantly, Europe yet.
And I would say for us, timing couldn't be better. With the public markets in retreat, a lot of the alternative asset managers also in retreat. Having an $800 million fund is kind of a rarity in the corporate VC space. We have a lot of dry powder, and we can actually write a $20 to $40 million check. So when I think of the opportunities that can come our way, we're well positioned to take advantage of those. And not only that, but we exist to lead the transformation of Toyota from an automobile manufacturer to a mobility company. So that really broadens the scope of the areas that we're looking at. We also have a project called Woven City, which is a prototype city of the future that's being built from the ground up, and it's going to redefine mobility. We often just think of mobility as the movement of people and goods, but we also add the movement of information and data. So when you add that to the scope, it becomes a really good opportunity to be in the market, particularly in the growth equity if the rest of the market's retreating and slowing down.
Yeah, wonderful. And Jeff, so full disclosure, before starting a software company, I was a corporate attorney and worked with Jeff at DLA some years ago. But Jeff, you and by extension DLA, you guys have probably some of the best purview into the market. And so I'm curious what you're hearing from your clients, corporate and otherwise, in private companies.
Well, I mean, I think we've heard kind of consistent themes throughout the day that things are slowing down and becoming just a little bit more thoughtful in evaluation of the opportunity and the pricing. In the corporate venture world, it's been very interesting. There's been, it's basically a flight to either side, I say. We do see people that have traditionally done growth rounds to either a partnership or an exit, be much more willing to not continue to support a portfolio company. Portfolio management, I think, has become very much a focus for well-run CVC units. And at the end of the day, the stigma, which I do think was different for a CVC not supporting a portfolio company versus a traditional venture capitalist, I think that stigma is going to get significantly less, and it's going to be challenged to be an issue for somebody to say, I'm just not going to write you another check. Similarly, we've seen funds move down market. As Kelsey said, it's a little easier to get capital if you're a company that's well set up for a Series A right now. But it's a great opportunity for funds that are well established within their company and have an excellent value proposition already, because the biggest challenge for somebody that's moving into a space that may not be necessarily their sweet spot, their original charter, is how ultimately are you going to deliver the value to your company that you're chartered to do. So, we see, I think, great opportunity for people who want and have the ability to be flexible, but who have a well-established situation within their corporation. If you don't, and as James said this morning, since 2020, there's been 1,000 new CVCs. I think we're going to see a lot of shakeout in that as people go through the next, call it, year and a half through the end of 23, because a lot of people are going to be chasing deals. It sounds like Lukash saw that with a couple of deals they were priced out of lately, because people are at an early stage still willing to give valuations, whereas at a later stage right now, I think people are waiting around to see if there's going to be an exit versus funding for additional growth in a lot of situations.
If I may follow up on what Jeff was talking about, one of the things I feel really lucky about being part of the Toyota Group is we actually have a number of different vehicles available to us. So we have a sister fund called Toyota Ventures that does the early stage seed investments. They're part of Toyota Research Institute. And then I'm dual hatted. I'm the managing director of Woven Capital, but I'm also the head of investments and acquisitions at Woven Planet. And we built a standing corporate development team. And Toyota doesn't have a standing corporate development M&A team within the company, but we're actively, and some of you may have heard of some of the acquisitions we did last year, Lyft's Level 5, self-driving team, Carmera, Renovo. So I think for all the corporates out here, it's really imperative that you really have kind of a multi-stage view of the market, not just be focused on, let's say, seed and Series A, but have vehicles and opportunities that allow you to do the later stage or to do M&A. You really, when you think about it, they're all just tools in a toolkit, and depending on what you're trying to solve, you'll need access to different tools.
Yeah. Well, Jeff, if we could stick with you. So one of the obvious implications of startups raising less capital than they had, at least at the rates that they were in the prior year or two, there's a big focus right now on capital efficiency and towing the right line between being capital efficient and growing at a healthy pace. And just curious your thoughts as to how some of the companies that DLA works with are thinking about their operating models, because companies that raised last year and the operating plans that they likely sold to their investors battle tested against the conditions this year are not going to work. And so how are you seeing companies sort of react to that new reality?
Yeah. So the reality is that the metrics are more important than ever now. And the challenge for companies is that the metrics are continually moving now. Before you could fudge where you ended up on delivering on your metrics. And for a good-sized round right now, there's a much higher level of confidence required from investors in the achievement of the metrics, because there's less likely an ability to just find more capital on the next round. So people have to be committed in a lot of instances to writing larger checks because they're looking for longer runway, or at least assured longer runway. And so I think you're seeing companies are being pressed a lot more on their operating plans and their models in order to make sure that, that they're going to hit those metrics. And the challenge is that the metrics that everybody was looking at, a year ago or 2 years ago, are the goalposts are moving on those. And as a result, I think corporates can add a lot of insight because they've got an ability to fund with, essentially an insight into what the metrics are around the corner in the industry. A little different for you when you're investing outside your industry, but the ones that are investing adjacent to their industry, I think, have a better insight into that. And so what we're seeing is a lot of people get some serious validation from the corporate investors when it comes to the financial investors as well around that business plan and the metrics.
Yeah, Lukash, if we could turn to you, is there any advice that you're offering to companies in the portfolio right now? I'd just be curious how you're thinking about that as an investor, but also potentially as a strategic partner.
Yeah, sure. So I think that first and foremost, we actually try to reassure the companies that we are in this together. And to us as a fund, it's important. We see this as a long-term partnership. So that's the messaging we are trying to send, that we will help them weather the storm. But in terms of the practical advice, I think a lot has been said today. Probably the one, sort of the most operational one, is that for the portfolio companies that either have or can secure long-term funding, 24 months plus, we advise them actually to become aggressive and pursue the business opportunities that market environment will create. For the ones that don't have that luxury, we do advise them to look into the cost base, into the marketing spend. We also try actually to be helpful and open doors within the corporate. So in the environment where the other external opportunities or projects might dry out, we are trying to substitute them with what our corporate can bring to the table.
I was actually just going to follow up on something that Lukash just mentioned, and that is, for us as a growth stage fund, with the exit opportunities drying up, the public markets, the SPAC market, like if we go back 2 years, within growth, you often would hear one and done, because the valuation is going to jump so much in the next round. Your pro rata is going to almost be meaningless, or they're going to be offered an opportunity to go public through a de-SPAC or IPO. But those are gone. And so even for us, if we're going to write a $30 or $40 million check, we need to be prepared to write another one potentially in the next round, because we haven't hit bottom yet. Let's just all accept that. At least that's my belief. The market is still going to go down, I believe. And so even if they can raise 24 months now, in 24 months, there might not be a recovery in the public markets and an exit opportunity. And that's also why it goes back full circle, what I was saying in terms of having multiple tools in your toolkit, having an M&A, corporate development. And if you don't have one now, I'll just tell you from experience, it is a muscle that you have to exercise. You can't just say, we're going to go do M&A, because it's a company-wide effort. It's not just a transaction. You have to make sure your HR, legal, finance, communications, IT, facilities, all are ready to integrate that company. So it's not just product and an M&A transaction. But if you have that, there's going to be a lot of M&A opportunity over the next couple of years as those companies see that as their only exit opportunity.
Yeah, if we could dig into that theme a little bit more, is there any unique role or value that you believe strategics can bring to their companies right now?
It's an interesting question, because one of the things that we're building right now is a portfolio success team who will be measured on making sure the portfolio company is successful. And I've heard a lot of people today talk about how corporates can bring more than just money. But I think what it really comes down to is mindset, and also what Lukash was saying about patience and really giving them good advice. Many of us today are in the position that we're in because our parent corporations have weathered difficult times in the past. And how do we leverage that internal knowledge and share it with the startups that we're working with? Like, hey, things will be okay. here's what you need to do, and really be advisors to them and not just sources of capital. We often talk about corporate VC as a way to bring in market insights, but I think the flip side is just as important. And like in my case, I've been with Woven Planet for 2 years. I don't know all of Toyota's history, so it's incumbent on me to learn what Toyota has weathered through the years and how it came out the other side so that I can share that knowledge with the startups. And I think that's where law firms, especially because they're right there often during those painful times, can also provide a lot of insight.
Yeah.
Can I quickly maybe just to build on it? I think that now to your question, I think that now is actually time to walk the talk for the corporates and see what they can bring to the table, and just to maybe give you a tangible example. So we as BAT operating in 180 markets, and we invested in 2 functional food companies. One is energy chewing gums, another one is caffeinated chocolates. And actually in those times, we are trying to open the new markets for them so that they can scale up. They are sort of struggling a little bit with performance in their core markets. So what we are doing, we are taking the energy chewing gums into Sweden, caffeinated chocolates, helping them expand in Canada. Those are just examples. Bottom line is that I think that now is the moment that we exercise our muscle that we have as a corporate, and we actually help them out, because this is the moment to act.
Absolutely.
Yeah, and I thought I'd give you a chance to just even talk about sort of your unique fund's investment approach and thesis, and particularly how you can bring some of that strategic value to the portfolio that you build and are building.
Yeah, so I think that from our perspective, it's quite peculiar sort of situation, because we are trying to help our parent diversify away from the core business. So the way we are looking at that is that in those sort of new categories, like I mentioned to you guys, functional food, we are trying to open new markets and leverage BAT's distribution to help them scale abroad. So for example, the energy chewing gums is the UK-based company. We help them in Sweden. And then in the capabilities area, or what we call capabilities, so think of this as a supply chain operations or digital marketing, we are trying to bring the parent as the customer to the startup we invested in. So we just had a very successful exit from the company called Welo in Brazil. It's the last mile delivery. We invested, we partnered them with our operations in Brazil. They scaled up in Brazil. They are going to launch in Colombia and beyond. And that's how we think we added to the value creation of the startup.
Yeah, wonderful. Jeff, I thought it'd be good to ask you, have you seen anything in terms of deal terms and structure, and have those wins changed dramatically over the last quarter or so?
Yeah, I mean, so I would say not dramatically other than valuations. I do think you're continuing to see some corporates look at M&A hooks and look at M&A paths and look at control investment paths. And in this environment, I think you're going to see companies be more open to that because their capital alternatives are fewer. So I'd expect to see that kind of come a little bit more back for some of these new entrants that are coming into the marketplace. You know, we spend all our time talking about why hooks and other relationship rights actually make your capital less attractive. And I think in a softer market, people have a little bit more opportunity to pursue things that are strategically important to their parent company, especially if you're looking at a CVC that's 1 or 2 investments here or there, really more as a initial tool for an M&A event versus just get into the ecosystem investment. So I've seen that come in. I've also seen some valuation changes based on corporate metrics that we never used to really see because everyone was just pricing it as a financial VC round with the corporate even leading. We've seen some corporates now that are doing deals that have financial terms tied to a commercial deal that ripple back through the investment as well, which I hadn't seen until about 6 months ago.
Cool. Well, we got just about a minute left here, and my teams, I always like to end a good discussion with hot takes. So I thought we could maybe just go down the line. Maybe we've got a preview of George's, but where do you guys see us in 12 months? Maybe just give me your hot take.
Well, I'm going to quote Wayne Gretzky. For those of you who are Canadian or big hockey players, he said, good hockey players play where the puck is. Great hockey players play where the puck is going to be. And that's really what our job is to predict where the markets are going to be in 12 months, in 24 months, and be there for our portfolio companies. I don't have a particular prediction on that, but I do believe for corporates, more than anything, and this term was used earlier today, to be the lighthouse, to really, and as Lukash said, here's our opportunity to really shine and show that we can bring more to the table than just money and really be a true partner and supporter of the companies we invest in.
Great.
I completely echo that. Let's not forget that some of the best businesses out there have actually started to shine during the downturn. So I think that this is also time of the opportunity. Perhaps in 12 months, things will not change dramatically, but for the best performers, there will always be a market, and actually this is an opportunity to grab.
Yeah, and I'll just lead with the one positive note is there's so much capital that's been raised, there's so much capital that needs to be deployed, that there's an inability to not have deals continue to flow. So I think we'll see that. I think it'll be a flight to quality, obviously, and we'll lose a lot of people along the way, but there's so much money out there that needs to be deployed, we'll still see it deployed.
Yeah.
Wonderful. Well, yeah, thanks, guys. I think that's our time, and appreciate the thoughts.
Great. Thank you.